What's going on, guys? Bexio back, and today we get a brand new video, and we all know the age-old saying, buy the dip. But this might not be the right time for that, as we've seen lots of things going on with stock market, Bitcoin, and crypto, and the Fed. Everything's going absolutely crazy and ridiculous. So there's a lot of things to maybe look at before deciding to buy the dip. But, ultimately, if you can afford to just dollar cost average in, that's always been the best strategy. But we know right now that we're dealing with something that is not dealt with often a lot of the times, which is a Fed that is a super hawkish Fed. Seeing right here, peak hawkishness out of the Fed because of inflation. They got to try and control inflation without crashing the stock market and causing a recession. And they want to do all of this and kind of a soft landing, they say, but probably not going to happen. But we can see out of this, first up here, have the Federal Reserve ramping up its hawkish tone and suggesting large interest rate hikes are coming to get an overheating economy under control. So a big problem right now is consumer spending through the roof. It's not going down. It's not slowing down. It is speeding up. So trying to get that down without, causing recession already by itself, that one factor, very hard to do. But that's how you can try and control inflation, bring down consumer spending so that there's not so much people trying to buy goods. Obviously, supply and demand. If you have lower supply and demand skyrockets, the price is going to have to go up. So right now, that's one of the big things that they're dealing with for these interest rate hikes that they're trying to control, as well as just making it slowing down the movement of money. Because if the money keeps moving how it is, inflation is going to keep skyrocketing like it has been. So big problems that they have to deal with. We know that they used to be super dovish. Jerome Powell, at least the head of the Federal Reserve, was someone who was not kind of out there saying, 50 basis point hikes, we got to go hard, way harder interest rate hikes, we got to make sure we get inflation under control. He was kind of the guy who was sitting there like, we believe in our slow approach that it's going to work out over a longer period of time. And now he's flipped, and he was one of the only ones in the Fed that's kind of like, we'll just be careful what we're doing. And now they're all just sitting there and saying interest rate hikes, start doing them, skyrocket it. But they say they don't want a recession, but it's probably inevitable at this time. The odds are actually insane. But if you look at what Powell is saying, you can see he said putting a 50 basis point rate hike on the table for the Fed's meeting early next month and leaving the door open to more outsized moves in the months ahead. Already massive. So that's what we just said is his complete U-turn on everything. He was starting to get a little hawkish, but he was the dove of the Fed, of kind of saying, we're going to take it slow. We're going to stick to what we said we're going to do and kind of go here. And now, obviously, a couple months later, sitting here and saying 50 basis point rate hike, and we might have to do way higher ones in the future and leaving the door open. So could see some massive moves of multiple 50 basis point, 0.5%, which would be very bad for the market. I don't think the market's pricing in more than one. It's trying to price in maybe one right now, expecting one, but I don't think it's pricing in another one. So a lot of things hitting the market here. And then you have the central bank wants to engineer a soft landing for the U.S. economy, aiming to tighten monetary policy to fight the hottest inflation in about 4 decades without triggering a recession. Can they do it? Probably not. And why we can say probably not. This chart right here, the yield curve, showing us the 10-year treasury against the 2-year treasury. So every time we've had this flip under or go negative, meaning the 2-year is returning greater returns than the 10-year, then we see a recession follow soon after. And we recently have went under it and spiked back up, but now we kind of went under, had a little move up, and are coming right back down to it. But if we zoom out all the way, we can see every single time we've had underneath this line, recession, under the line, recession, we got under it, recession, under it again, recession. It's always been a pretty good indicator, except for one time, which is right here, where it kind of went under but spiked back up. So the question is, are we seeing that one this time? And even recently, with this kind of touch and started coming back up, people say the only reason we had this small recession is because of the pandemic and stuff. So maybe we don't see a recession. I don't see how the Fed gets out of it without one, though. And this is an interesting chart, kind of looking at S&P profit by wage CPI, so like wages compared to S&P companies' profits. And there will always be something to look at to be bearish and say the collapse is coming, it's all over, this is the worst time in the world to be investing. People say that literally every single year. We have every year there's just something saying the bubble's about to pop, the bubble's about to pop, oh my god, the bubble's about to pop. So we can see here, though, this chart just kind of says .com bubble. We see it kind of get up there. Profits are soaring against wages, and then it falls all the way back down. Profits not so good anymore. And we get to the housing bubble. Things are looking great, and all of a sudden it's not so great. And then it seems like quickly recovering, going up here, and then we have it all the way up to pandemic bubble right now. But the problem with how a lot of people look at this is you'd see .com bubble, you see this top here. Once you get back to this, there's people screaming, oh my God, bubble's going to pop. It's crazy. And then for a long period of time, they keep saying it and saying it and saying it. And eventually something happens and we see it pop and they say, see, I was right. You were all thinking that it's going to be fine. And then it comes right back up. And when it gets back to this level, say, oh my God, it's going to pop. We're all going to go to nothing. Everything's popping. And it continues going up. And they're saying, guys, this is crazy. It's going to pop. It's going to pop. And all of a sudden, now we're all the way up here. And they've been screaming that this is a problem since down here. So you miss all of this upside in stocks and earnings and upside potential and assets, while sitting here and saying this is crazy when there's not really anything too crazy going on. People call for bubble pops and recessions, all these problems all the time, and the best thing that you could try and do is just stay in the market. Day trading is not the answer to anything. Trading in general is not really, statistically, it's not on your side. So the idea would be stay in the market, not overextend yourself and put so much money in that if something goes down 10%, you panic and you're wondering what's going to happen. That means you have too much money in the market. But if you can continue just dollar cost averaging in, buying things, ETFs even, so you don't even have to do any work, stock picking, just buy the S&P, buy VTI, something like an ETF, and just dollar cost in, stay in the market. It's always been a proven strategy over a long period of time that it actually works. And if we look at stocks here, we can see obviously lots and lots of red going on. Just bad day in the market. The Fed super hawkish. We got just big earnings coming up. A lot of big company earnings this week. So market's very scared about that. Pricing in recession fears, interest rate fears, bad earnings fears. It's just fears all around. But you can see companies like Apple is down almost 4%. That is crazy for Apple. Tesla down over 11. We got Dogecoin down 11. Just had a huge pop. It's already down. Netflix continuing its downfall. Google's down 2.5%. These are blue chip giant companies that print money, and they are suffering bad. That's just how bad this whole macro thing is that's going on. There's just so many problems that people are in full fear mode. But if we look at the S&P 500 right here, we can see obviously have a couple of these lines just drawn out, just marking like bottoms, tops, how this is kind of moving. I don't really pay attention to the S&P to draw lines on it, but we can see we had one where we went under this line, had a huge jump up. We're now under it again. Maybe we see the huge jump up again, but there's just so much fear. We've been caught in a downtrend since 439. We're at 384. So this downtrend has been pretty brutal. I don't know if it's officially in bear market territory, if it's down 20%. I think things like the NASDAQ or the Russell 2K would be, but I don't know if the S&P is there yet. But just lots of fear. And the age-old quote from Warren Buffett, to be greedy when people are fearful and fearful when others are greedy. So this is the other half of that. A lot of people like to quote it when things are getting bad like this and buying dips to say they should do it. But a lot of fear right now. like anyone would say, this right now could be a massively great buying opportunity if you can manage to buy and hold for 2, 3, 4, 5 years, a long period of time, and not have to worry about the money. This could be a massive buying opportunity. So ultimately, we have a lot of things happening in the market, lots of fear, lots of pricing in of fear to try to make sure the market can kind of expect what's happening when no one even knows what to expect is going to happen. So obviously a lot of confusion going on all around. It affects everything, the stock market, crypto, everything is getting affected from this. Nothing is safe. But right now, living up to the Warren Buffett quote would be probably the better move. And we've always seen recessions don't last super long. Typically, if you can buy during recessions, the bull runs after, or the spikes after, can be massive and just have tons of returns in them. Dollar cost averaging could still easily be the best bet here, but that's gonna do it for this video. As always, don't forget to smash the like button and subscribe. We're on the road to 1,000 subscribers, and I'll see you guys in my next video.